Welcome to Good Money Guide TV. App of the day is Wealthify. Although they're actually not just an app, you can also invest on the website. This is a nice feature because actually a lot of the new breed of investment platforms are app only. In fact, Wealthify also just won Best Managed Stocks and Shares ISA in our 2023 awards. If you want to see our latest thoughts on Wealthify, go to the Good Money Guide for our most up-to-date review and ratings. You'll have to bear with me here because when I wrote this Wealthify review, their CEO had just announced that he was doing a sort of Ironman triathlon around the Lake District. And having cycled the lakes myself and having just hobbled around the London Marathon, I know just how crazy that is. So there are quite a few sporting similes in this. I should have guessed really, because when I interviewed Andy, the CEO, he was wearing activewear. For years, people have been trying to make investing interesting, but it's not. It's dull. Trading is fun. It's high risk, dangerous, and fast, a bit like sprinting. But just like trying to run too fast, especially when you hit 40, you'll probably injure yourself. Just as in trading, you'll probably lose money. Investing used to be like a marathon. You'd have an annual 4-hour meeting with a wealth manager who would recite your fund prices from the back of the FT before rolling your portfolio over for his annual commission. But now it's seemingly even harder work. To make investing interesting, robo-advisors like Wealthify, or digital wealth managers as they prefer to be called, have been trying to democratize it and make investing open for everyone. They say, look, investing can be fun. If you don't want it to be a marathon, we'll make it a triathlon instead, which, as you know, takes roughly about the same amount of time as a marathon, but is a swim, a bike ride, and then a run instead of just a run. And this closely translates into investing similes as it's a massive slog, but we'll make it more interesting by giving you an app like Strava so you can track your performance in real time, and we'll give you variety by risk and region. So by democratizing investing, robo-advisors have actually made it harder. You have to make more decisions, be more involved, and you've got an app so you'll be constantly looking at and therefore perhaps tweaking your ISA and pension, when actually what you should be doing is investing and then doing nothing. Or should you? A while ago, I interviewed the Wealthify CEO, Andy Russell, and one thing we discussed was how important it is to encourage people to start investing instead of saving, because without the benefit of compounding returns, in the long term, if you just save and don't invest, your money will be worth less in the end. Andy told me people are walking past their own money, really, as they're missing out on that opportunity for greater fund growth. Now, clearly, if you try to convince the young to start investing by explaining how compounding return works, you're going to have no customers at all. But one thing Wealthify does really well is straight off the bat tell people how much their money could be worth in the future, particularly for those making regular investments. This is a very powerful message to send, and one that should always be front and center. Because generally, the earlier you start investing, no matter how small, the better off you're going to be in the future. When I was setting up a Wealthify account, I said I'd invest £100 a month with one of their adventurous plans, which Wealthify said after 23 years, could be worth 43 grand or 34 grand if you take the more cautious approach and go with their cautious plan. Think of the rubbish you spend £100 a month on. When I retire, I might be able to finally buy a sports car, although I'd probably be too old to drive it. I did ask Wealthify on Twitter where this prediction came from, and they came back with a really helpful thread explaining the calculations. Obviously, past performance is not indicative of future results. You'll see that anywhere. Because if the market tanks, which it always does at some point, you're going to be sitting on a loss at some point. But before robo-advisors came along, if you wanted to open an account and invest with low to medium risk, you had to go to the bank, sit down with an advisor, fill in a load of forms and nod in bemusement as they explained why the Asia ex-Japan Emerging Markets Fund would potentially make you more money than a treasury-based fund of funds. I remember doing it 20 years ago and it was utterly exhausting. And I'd just come back from working on the NYMEX oil trading floor in New York, so I was in the business back then and really should have understood what they were saying. Thankfully now, though, it's so easy to open an account and invest, and that's where the real democratization of investing is. The way people are invested is basically the same, with diverse portfolios spread across asset classes and regions, albeit cheaper with the use of ETFs instead of active fund managers. People have always been able to invest monthly with even very modest amounts, but what makes investing accessible is not how it's done, but how easy it is to get started. Even up to a few years ago, if you wanted to open an ISA account with someone like Hargreaves Lansdown, you had to fill in a paper application form and post it back. But with Wealthify, I didn't even have to put in a password to get started. I managed to fund my account without getting my debit card out of my pocket by directly linking my bank account. This is a massive bonus for regular investors, because if you invest or make payments with your debit card and it expires, your contributions stop, whereas if your bank is connected, it will continue indefinitely. I think overall it took less than 5 minutes to get a plan set up and funded. It's a very slick app and website, and everything is there where you expect it to be. There will always be a debate around active versus passive fund management, but the performance difference between wealth managers is generally very slim, and there's a fairly standard way to create these risk and region-based portfolios. Plus, if you want to beat the market, you have to take on more risk. If you just want to beat inflation, you probably won't beat the market. One of the main advantages of robo-advisors is how cheap they are compared to traditional wealth managers, because you don't get personal advice, everything's online. And Wealthify is one of the cheapest of the bunch. Wealthify fees are about 0.6% a year of your portfolio versus Nutmeg and Money Farm, who are about 0.75%. So if you have 100 grand on account with Wealthify, you'll be paying £600 in fees as opposed to 750 with the others. Over a 23-year period, that's a saving of 3,450 quid. And that doesn't take into account compounding returns if you reinvested those annual savings. You do, of course, have to pay fund fees on top of that, which again are slightly cheaper with Wealthify. They say their average fund fees are 0.16%. Nutmeg and Money Farm are about 0.2%. These fund fees are the costs of the assets in the Wealthify plans, which are managed by investment professionals. For example, Wealthify plans are made up of funds and ETFs from companies like Vanguard, L&G, HSBC, Fidelity and Mercer. All those funds charge a fee for choosing and managing the assets that the funds are invested in. If you want to know what's in the funds, you can look it up on a website like TrustNet. For example, if you look at the Vanguard US Index Fund, which is currently about 23% of Wealthify's Ventures plan, you can see that actually, just like everybody else, your investments are quite heavily linked to US tech stocks like Apple, Microsoft, Alphabet, Tesla, and even Warren Buffett's Berkshire Hathaway. For the more ESG and ethically minded, you can invest in their Ethical Adventurous plan. Assets include funds and ETFs with sustainable in the title, like the Lion Trust Sustainable Global Fund that contains stocks like Thermo Fisher Scientific, a US stock worth around 200 billion that, among other things, makes scientific instruments to make people better. I also really like Wealthify as a business. It seems that there are new investing apps being set up every week, all with different USPs, but most are woefully underfunded. And you've got to wonder how many times they're going to be back to Seedrs and Crowdcube to tap up investors because their burn rate's extortionate and they've yet to onboard a meaningful amount of customers to generate revenue or even, God forbid, make a profit. Wealthify's gone through this, but come out the other side. They were founded by Michelle Pierce-Burke, started with £500,000 from Richard Theo in 2015, then a further £1 million from crowdfunding on Seedrs in 2016, followed by 15 million from Aviva in 2017. Wealthify was then fully bought out by Aviva in 2020, which, if I were to found a new fintech, that would be my ideal roadmap. Even though I have invested with Wealthify, I wish I'd invested in Wealthify. But that's a whole other story, and one with a completely different risk appetite. Now, being Aviva owned is great for clients because it offers a huge amount of financial security. And of all the robo-advisors out there, only Wealthify and Nutmeg, who's owned by JP Morgan, have the backing to ensure that they may still exist in 20 years' time. This is important because investing isn't like using a credit card or buying car insurance where you can switch every year. When you invest, you may well be with that provider for another 50 years. Now, When I interviewed Lindsay Ricks, the head of savings and retirement from Aviva, one of the reasons they were interested in Wealthify was because it gives them a chance to get people investing who may have been put off by the established and grown-up nature of Aviva. She told me Wealthify plays a very important role for certain types of savers, which means we offer a broad range, both of digital journeys that customers can invest in, but also we think it important that many of our pension customers to have the opportunity to talk to people as well. You can tell Wealthify is owned by one of the bigger boys like Aviva as well, because even though it's very easy to set up an account, they're still heavily on the compliance. I actually failed the suitability test. I filled it in as though I was a beginner investor when testing the platform, and I was told I couldn't actually invest because I didn't understand the risks of the stock market. Although I retook it a little bit later with a greater appreciation for risk and was granted permission to create a plan. But it's a good example of how, whilst everybody should be able to invest, not everybody should actually invest. Now, if you're of the social media persuasion, you can also use their Refer a Friend program to get a £50 bonus in your portfolio if you introduce a friend who invests more than £250 and leaves it there for 6 months. Because after all, just like training for a triathlon, if you do it with friends, it's easier. And just like investing, if you take an active interest in your health, you will be healthier and wealthier in the long run. If you've used Wealthify or go on to use Wealthify, come to the Good Money Guide and tell us what you think. Thanks for watching.